Hello, this is Dr. Nunez. Welcome to the Chapter 22 lecture on budgeting. Let's get started. Budgets play an important role, a very important role for organizations of all sizes and forms. The objectives are key. Establishing specific goals in budgeting are very important. Executing plans to achieve those goals is important, and then periodically comparing actual results with the goals. Budgets provide what I like to think of as a benchmark, and that benchmark is used to measure performance and to compare results with to see if you've achieved those goals. And budgeting affects four key management process functions: strategic planning, measurement, evaluation, and control. So strategic planning involves setting goals to kind of guide management decisions. And then measurement involves quantifying how well the company is achieving its goals. And evaluation involves monitoring the operations by comparing the actual and the expected results. And then control involves taking actions to encourage specific kinds of behaviors to meet budgeted goals. And when a company uses participative budgeting, that means when they get everyone involved, when they get all management at all levels involved, employees get to work with their supervisors to develop, specific performance metrics and budgeted goals, sometimes called performance targets. And a budgetary unit of a company is typically called a responsibility center. And when you allow these responsibility centers to, again, participate in the budgeting, then you get a very useful tool, something that's very helpful in terms of helping a company achieve their goals and meet those specific targeted goals and behaviors. What we're going to look at in this chapter is what's referred to as the master budget. The master budget is really kind of a textbook term, you know. In practice, sometimes companies will call it the plan or the annual plan. But in a textbook setting, it's typically just referred to as a master budget. And what this master budget is kind of an integrated set of both operating and financial budgets for a specific period of time. Usually, when a master budget is prepared, it's on a yearly basis. Sometimes you'll see companies doing strategic planning that will span anywhere from 3 to 7 years. And then the master budget is just 1 year. So it's one part of that strategic plan. And typically, the master budget begins with preparing the operating budgets. And we're going to look mostly at individual pieces of the operating budget in this chapter. And those operating budgets typically will form that budgeted income statement. And we'll look at how those operating budgets fit into that income statement, and then how the financial budgets fit into the entire process of budgeting as well. And we'll see those relationships in just a few minutes. So this is a pretty good summary of the components of this master budget. And this is for a manufacturing company. So again, we've got two key pieces, the operating budgets and the financial budgets. And the key components of this operating budget are what you see here, the sales budget, and then the cost of goods sold for a manufacturing firm, which of course would include, production materials, labor, and overhead, the typical manufacturing costs. And then also we would have those period costs, the selling and administrative expenses. And all of that would feed into this budgeted income statement. And then ultimately we would end up with a budgeted balance sheet when we combine this budgeted income statement with the other financial budgets, the cash budget and the capital expenditures budget. And again, our focus will primarily be on a few aspects of the operating budgets. So as we look a little bit more closely at the operating budgets, again, the starting point is the sales budget. Everything kind of starts here, because once we've determined what we think we can sell, then we have to determine what we need to produce. And once we've determined that production, well, then we can determine what we need to support production in in terms of direct materials, direct labor, and the factory overhead. And then all of those three items will feed this cost of goods sold budget. And then, of course, we have those non-manufacturing costs, which would be the selling and administrative expenses. And then all of those will then feed that, both of these will feed this budgeted income statement. So again, this master budget is kind of an integrated set of budgets, and it's supported by two key ingredients, the operating budget and the financial budgets. And the starting point in the operating budgets is again the sales budget. And the sales budget usually starts with estimating the quantity of sales, what we think we can sell for the year. And that typically would come from the sales department. And usually the starting point is the prior year sales. And then you build on that. And once we've determined, once we've revised those quantities and determined what we think we can sell, the next step is to budget the sales revenue. The sales revenue is nothing more than a function of sales volume times sales price. It's what we think we can sell, expected sales volume, and what we think we're going to sell those units for. So in this example, this manufacturing firm, Elite Accessories, they've put together the components that are needed for a sales budget. They've estimated what they think they can sell, in the East region, the sales volume by product, and in the West region, what they think they can sell, sales volume by product, and what they think the expected selling price is going to be. Those are the components that we would use for the sales budget. So very simply, the sales budget is really nothing more than the expression of price times volume. Right. So what we have here is the expected volume by product. So we've got the wallet product, we've got the handbag product, we've got total sales, right? Total sales for wallet, total sales for handbag, those two products, and then what we think we can sell them for. $12 for the wallet product, $25 for the handbag product. So we've got total sales by product, put it all together, and we've got a sales budget. Again, it's nothing more than price times volume by product. And then we add it together, consolidated, and we've got a sales budget. Price times volume, total revenue. Next, we'll look a little bit at production. So we're going to look a little at the sales budget in the homework assignment and the quiz. And then we'll also look a little bit at the production budget. So the production budget is really kind of closely related to the sales budget. The production budget really is a function of the sales budget plus what we have in terms of inventory needs. So again, that starting point really is the sales budget. The sales budget is what we use to ensure that the production needs will satisfy the needs of our customers throughout the year. So the production budget estimates the number of units that have to be produced in order to meet our sales and inventory requirements. So the basic format is what you see here, right? It's what we expect to sell, right? The expected units to be sold, plus the desired ending inventory, minus the desired beginning inventory, equals the total number of units that we need to produce. That very simply is what a production budget should look like. It's what we expect to sell, plus what we need at the end of the period in the inventory, minus what we start with in the inventory at the beginning of the period. Those are the number of units that need to be produced. So in this example, back to Elite Accessories, their expectation of inventories by product. So two products again, wallets and handbags, and the estimated inventory at the beginning of the period, right? What we anticipate having on hand in inventory by product, and what we need to have in inventory at the end of the period by product. So again, this is the format for the budget. We've got some basic information about the inventory at the beginning of the period, inventory at the end of the period, and we've got our sales budget. Put those three pieces together, and we've got a production budget. So the production budget, if we focus on this first product, the wallets, they expect to sell 528,000 units. Again, that's from the sales budget. And we desire to have an ending inventory on December 31 of 80,000 units. That means that we need to have available 608,000 wallets during the year. And we're going to start with 88,000 wallets at the beginning of the year. So we don't need to produce 608,000 because we're going to have 88,000 at the beginning of the year. We're only going to produce 520,000. That's our production budget. Production budget is a function of sales plus the ending inventory minus the beginning inventory. So you can also think of it as this way. The production is sales plus or minus the change in inventory. So what's happening is we start out with 88,000 units in the inventory, but we're going to end with only 80,000. So we're going to actually reduce the inventory from 88,000 to 80,000. That's why we're only producing 520,000. We plan to sell 528,000, but we're only going to produce 520,000. Why are we producing less than we're going to sell? Because 8,000 of them are coming from inventory, right? We're taking this inventory down from 88,000 to 80,000. So one way of looking at that production budget is, it's sales. In this case, sales plus we're going to produce enough. It's either plus the increase in inventory or minus the decrease. So it's our sales volume of 528,000 minus the decrease in inventory. 528,000 minus the decrease in inventory gives us our production. And same thing for handbags, right? We expect to sell 280,000 of these units, and we need to have 60,000 of them on hand at the end of the period. So we need available 348,000 handbags during the period, but we're going to start with 48,000. So we only need to produce 292,000. Right? So we're not going to produce 340,000 because we have 48,000 already on hand at the beginning of the period. So we're going to produce 292,000. So we're producing a lot more than we're going to sell. Why are we producing 12,000 more than we're going to sell? Well, because we're going to bulk up the inventory. We're going to increase the inventory from 48,000 to 60,000. So we're producing enough to cover our sales plus the increase in our inventory. And that's our production budget. And also, to support production, we need materials. So we're going to look a little bit at the direct materials purchases budget, and that is linked to the production budget because we need to purchase enough materials to support our production plans. So we're going to focus on basically three key steps in this purchases budget. One is we need to be able to determine the amount of materials that are needed for production. So we're going to need materials for production, and we're going to need materials for inventory too. But the first thing is to focus on the materials that are needed for our production. So we have some plans, right, for production. We just looked at the production budget. We've got to make sure we have enough materials to cover our production. And then we also want to make sure we have what we need for inventory as well, inventory of the direct materials. So in this case, what we know about this product, the wallets and the handbags, is that we need leather and we need lining. So we've got to buy materials to provide enough leather and enough lining to make the wallets and the handbags. And these are the needs, right? We think of these as the standard amounts that are needed to produce the products. So if that's the case, then if we're going to make 520,000 of these wallets, and we need 0.3 square yards of leather. That's how much we need in terms of leather for the wallets. And if we're going to make, again, the wallets, and we're going to make 520,000 of them, we need 0.10 square yards of lining. Well, then that's what we need to produce wallets. And then we do the same thing for the handbags. If we're going to make 292,000 of the handbags and we need 1.25 square yards of leather, well, then that's how much leather we need. And same thing for lining. That's how much lining we need. So all we're doing is saying, okay, these are the numbers that represent our production, right? We go to the production budget that we just prepared, and these are the units that we plan to produce. And we want to make sure that we buy enough of the direct materials, at least to cover our production needs. So these are the quantities of materials that are needed for production. And then step two. Step two now is we've got to think about our inventory. So we have some needs for inventory. There's a desired ending inventory, right? We need to have some materials on hand at the end of the period to support the production next period. But we're also going to start with something, right? There's going to be some kind of a beginning inventory of direct materials. So we've got to factor in what we need in terms of our inventory. So step one was to look at our need of materials for production. Step two is to look at our need of materials for in inventory, the beginning inventory and the ending inventory. Next thing, step three. And step three is to determine how much it's going to cost, the quantity that we're going to purchase and what it's going to cost. So we determine the quantity to be purchased and then multiply it times unit price, and we'll have a direct materials purchases budget. Let's put all these pieces together. Given that we know what our quantities are that we need for inventory at the beginning of the period, at the end of the period, and we know what the prices are of these materials. So when we put this purchases budget together, let's start with only one of the raw materials, start with the leather. So in this case, for the leather, we've got 520,000 of I believe, the wallets that we're going to produce. And we need to have 0.3 square yards of the leather for the wallets. That's 156,000 square yards. And then for the handbags, we need leather as well. We're going to make 292,000 units, and we need 1.25 square yards. So that's how much leather we need for the handbags. So we're going to put all the leather together. This is 156,000 square yards of leather for the wallets and 365,000 square yards of the leather for the handbags. So these two numbers, right? That number and that number. That's what we need in terms of square yards of leather for these two products. And we have some kind of a desired ending inventory. We need to have 20,000 on hand. So this is what we need for production of wallets. This is what we need for production of handbags. And this is what we need for the ending inventory. Put it all together, right? So if we look at what we need for production plus what we need for the ending inventory, that gives us the total yards of leather that we need this period. But we're going to start with something. We're going to start with 18,000 square yards on hand. So that means we're only going to have to buy 523,000 square yards of leather. And the leather is going to cost $4.50. So this is our budget for leather, 2,353,500. So it kind of looks a little bit like that production budget, right? Production budget was we produce enough to cover sales plus the ending inventory minus the beginning inventory. Well, we're going to buy enough direct materials so that we can cover production plus the ending inventory minus the beginning inventory. It's the same concept. In this case, we have two products though. Same thing for lining. We need to buy some lining to support the production of wallets. How much? 52,000 square yards. So we're going to need 52,000 square yards of lining, 520,000 wallets at 0.10 square yards. And we're going to need some lining for the handbags. So 292,000 units times 0.5 square yards. So we have lining that we need for both products. So we need 52,000 square yards for wallets, 146,000 square yards for handbags. Put it all together, right? So this is what we need for the lining for both products, plus we need an ending inventory. That's the total amount that we need to have available. But we're going to start with something. We're going to start with some kind of a beginning inventory. So we only need to buy 195,000 square yards, and it's going to cost $1.20. Multiplied times $1.20, that's our budget. And the total purchasing budget, put these two together. We add these two together, this is the total purchasing budget. And again, it's a function of what we need for production plus the ending inventory minus the beginning inventory. Multiply times the price. We've got a production budget, a purchaser's budget to support production. So we're not going to look at all aspects of the operating budget, but we will look at a few key pieces. the sales budget, the production budget, and the purchases budget. And that's enough to give us a flavor for what goes into that operating budget. And then, in terms of the financial budget, we'll look a little bit at the cash budget. The cash budget focuses on cash inflows and cash outflows. And we usually think of those as cash receipts and cash disbursements. And we'll see both of those in the application assignment and the quiz. I think in this example that we'll see in this lecture, it's just the cash receipts, the estimated cash receipts or the cash inflows that I'll show you. And the cash budget can be prepared monthly, quarterly, or annually. The focus of the cash budget, again, our aspect, the one that we're looking at in this illustration, is just cash receipts. So in most companies, they have cash sales and they have credit sales. So we have the budgeted sales that they expect to receive in total by month. And this company makes their sales on credit. So what we need to be able to do is estimate the amount of cash that will be received from these credit sales each month. And like most companies, when they make a sale, they don't collect all of it in 1 month. So if you have total sales for a month, you may not collect all of the sales, all of the monthly sales in that month. In fact, in this company, based on their historical experience, what this says is typically what they collect in any given month is 40% of the prior month's sales and 60% of the current month's sales. So that's what their collection pattern looks like on average. They collect 40% of the prior month, 60% of the current month. So we've got our sales by month for January, February, and March. And let's take a look at what this cash budget will look like. And we're just going to focus on 1 month. We're going to focus on February. We want to look at what amount of cash will be collected only in the month of February. Given that their cash collection pattern is spread over 2 months. So the cash collected in February will be 40%, 40% of cash collected on sales in January, added to 60% of cash collected on sales in February. And the detail here, so again, based on their pattern in the month of sale. So when they make a sale, right? So for example, the sales that they made in January, they would have collected 60% of those sales in January, right? So 60% of that 1,080,000 would have been collected in January. And then the month following sale, they're going to collect the other 40%. So of January sales, 60% would be collected in January and 40% would be collected in February. And February sales, well, the sales aren't made until February. So in February, they would collect 60% of those sales. And then in March, if we were looking at March, we would collect the other 40% of those February sales. But again, our focus in this illustration is just on the month of February. We want to know how much we should expect to collect in the month of February. Well, in the month of February, we should be collecting on 40% of the January sales. 40% of January sales is the 432,000. And we should be collecting on 60% of the February sales. 60% of the 1,240,000 is the 744. So the total collections in the month of February will be $1,176,000. Those would be total collections, cash collections from sales in the month of February. Okay. Now, if we were focused on January, then we would be looking at whatever's being collected in January. But all we care about right now is what's being collected in February. We don't care about January. We don't care about March. We're only focused in this illustration on what's being collected in the month of February. And we'll get to see this a few times in the application assignment and again in the quiz. And I will see you again in the problem solving session for chapter 22.